I hope that you had an absolutely fantastic Thanksgiving. For us, while we were together with some friends, one of the people there asked what I thought was a really interesting question. Because as you know, interest rates have been on the rise, mortgage rates have been going up. And specifically, they wanted to know what the impact on home prices would be of rising mortgage rates. And, it's kind of natural to think that they are directly related, but they're actually not. So I thought it would be a great topic that we're going to dive into in this week's video. Hi, this is Andrew with the Andrew Smith team at eXp Realty. And as you know, mortgage rates have been on the way up. So the question becomes, or the question many people might be having, is as mortgage rates go up, what does that mean for home prices? And is there a connection at all? And there is a connection, but it's not a direct connection. And here's what I mean. The prices of any good or service is basically related to demand. Prices are basically a supply and demand issue. Demand is high and supply is low, prices go up. That's what we've been experiencing in the real estate market for well over a year now. Now, saying that, if mortgage rates go up too much, at that point in time, homes get more expensive. The payment goes up. And as the payment goes up, that could actually put downward pressure on demand. And if downward pressure is put on demand and supply levels come up, then we'll start to see some impact on home prices themselves. So I'm going to share my screen here with you and just go through a couple of quick slides to kind of explain this and take a look at what's happened in years past as we put all of this together. So here on this first slide, we've got a quote from Sam Qatar, who's the chief economist of Freddie Mac. And although mortgage rates have been increasing, and there's a lot been in the news and a lot of noise lately with regards to the economy overall, inflation, monetary policy. And now you've got potentially a new variant of the virus to deal with. And so what does all that mean? And ironically enough, for mortgage rates, it's actually been very stable for the entire year. For all of 2021, rate volatility has been almost non-existent. The rates have been within half a point. And that's not something that we usually see compared to past years. We see more volatility, more spread between the rates overall. As we take a look at this, some historical perspective kind of works here to kind of go through what this actually means. So this is going back to January 2020. And if you can see, right before the pandemic hit, rates were running at about 3.7%, 3.71, I think it was actually at. And they were dropping. As the pandemic hit, a lot of uncertainty in the economy overall, for sure. And we had that big spike, right? So rates jumped back up after falling at the beginning of the year. And then they continued a downward trend all the way into 2021, hitting a low point of about 2.65%. And now here we are as of last week at 3.1%. So you can see from a low point of 2.65 to 3.1, we're right there. I mean, there hasn't been a lot of spread, and we're still well below where we started 2020 before the pandemic. Now, as we compare that to years past, we can kind of, clarify the picture just a little bit. So this is looking at mortgage rates going all the way back to 2016, right? Represented by all of the different lines here. So, we've got 2018, they were at the highest here, just over 4, climbing up to nearly 5% before dipping back. 2016, we were under 4, got down just under 3.5 before shooting well back to about 4.25. And then 2017, much higher in 18, as I just mentioned. And then you had them just rapidly fall in 2020. And now here we are in 2021. So you can see, compared to the others, this line is relatively flat in comparison. And now here's where we stand as of when this chart was printed by Freddie Mac. That kind of shows, you know, comparatively compared to 16, 17, 18, and 19, rates are still phenomenal. And although they are projected to rise, we're not talking anything major here. Here's the latest mortgage rate projections that have just came out. And it's looking at what Freddie, Fannie, the Mortgage Bankers Association, and NAR are all predicting rates to be along with the averages. So you can see by the end of 2022, the fourth quarter, the average is about 3.7. That's been revised up just slightly. I know you may recall a video from about 3 weeks ago where it was forecast the fourth quarter to be about 3.5. So they're now looking at 3.5 in the third quarter, getting up to about 3.7. But again, 3.7 compared to where we were years past is still not necessarily bad. So that's where we are with regards to mortgage rates. So again, how does that compare or how does that relate to home prices? And what you're going to see here is home prices relatively are not impacted directly by mortgage rates. So let me tell you what you're looking at here. This is going all the way back to 2000. These bars here represent the annual pace of appreciation. And this yellow line here represents mortgage rates. So you can see going all the way back to 2000, we were in a falling rate environment. And during that time, obviously, home prices continued to go up. Even in 2005, as rates started to increase, which they did right here, home prices still went up. Okay, they still appreciated and continued to appreciate in 2006. The only time we saw home prices drop was a result of the crash. The crash is what brought prices down. Now, if you look here, when we go into the post-crash years, so right here, you're in about 2012, we right here at about 3.66%. As rates rose, home price appreciation is still running 9.6 and 4.9%. Again, you go a few years later, rising rates. As the rates are rising, home prices are still appreciating until you got here. Pace of appreciation came down, and then the rates tumbled as we moved towards 2020, and that's when home price appreciation really took off. So again, when you look at this, you can kind of see that the home prices themselves are not directly impacted by the mortgage rate. And if you, again, recall any of the videos that I put out previously, the expectation has been as mortgage rates rise, the pace of appreciation that we were going to be seeing in the market would start to slow. We'd see decelerating price appreciation, and that's already starting to show up. The pace of appreciation earlier this year, April, May, June, depending on where in the country, running anywhere between 19 and 22, 23%. We're seeing all of those numbers back off as we move deeper into the fall. And the median price of new listings in some markets, such as Temecula, California, where we operate, the median price of new listings over the past year is relatively flat. In Frisco, Texas, the median price of new listings right now is 10% higher than the median price of new listings a year ago. Now, again, those are list prices, not solds. I understand that, but it kind of shows the trend lines of where the prices have been. So we are still seeing price appreciation, and I do expect that to continue into 2022, but at a decelerating pace. We're going to start the year probably somewhere between 9 and 12% year-over-year appreciation, depending on market. And I think that's going to taper back down as we move further into 2022 at a slower pace. And the reason for this is the mortgage rates are one aspect of it, but it's the supply and demand. Millennials continue to be the largest segment of the population buying, and they're reaching prime home buying years now. I was showing homes to a millennial couple yesterday, and they were excited about the prospect of buying their first home. And we're seeing that over and over and over. The builders have been building like crazy. More supply continues to come on the market. And as people that currently own a home realize that there's new construction potentially that they can buy and move into, especially move up buyers, that will start to free up some additional inventory in the form of new listings, which we're actually already starting to see in some areas of the country. We don't normally see that until mid to late January, but in some areas of the country, we are starting to see an uptick in inventory so far. So, again, the right time for you to buy or sell when it's the right time for you to buy or sell. It's very difficult to predict the market. No one knows for sure what's going to happen. But as of right now, there are no signs whatsoever that you're going to suddenly see a downward spike in home prices or rapid depreciation in home prices. You're going to see prices continue to go up, but at a slower pace. Again, if something uncertain happens with the economy, or we go into lockdowns as a result, again, which I don't think we will as a result of any changes in the virus, then that could all impact it. But as always, if you have any questions about your specific situation and you just like to talk it through, please give me a call, 888-447-9650. Always happy to bounce some ideas around with you and give you the information that you need to make the best decision for you and your family.